So there are cases in which silver is destroyed, either permanently at the atom level, or it's just put into a product which is thrown in the trash, which to get it out, you would have to go run a mining operation in your local landfill. And there are thousands upon thousands of those across the US. Good luck doing that. Maybe silver gets to a price at the point which somebody's going to do that. They're going to run their dump trucks through there, grab all that crap, maybe burn off the stuff and extract out the silver. But I would think silver dollar prices per ounce would have to probably climb to at least $120, $150 an ounce for that to be profitable.
Physical silver faces significant structural tightening as large quantities of refined metal are permanently discarded in consumer products and industrial waste. Recovering these dissipated ounces from municipal landfills remains economically unfeasible under current market conditions. Rob Kientz, an acclaimed precious metals researcher and founder of GoldSilver Pros, projects that silver prices per ounce would need to surge to at least $120 to $150 to make landfill extraction and large-scale refining economically viable. This ongoing physical consumption, combined with years of accumulated structural deficits, suggests that the market could experience a massive valuation re-rating toward record triple-digit levels as available above-ground inventory continues to deplete. Now, we present the clips from Rob Kientz's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
This is the busiest eye chart you're going to see on the slide. So if you got to pause here, no problem. I have highlighted, however, some areas for you to look at. If you look in the green box, that is total supply from 2017 through 2026. And then if you look at the orange box, that's total demand from 2017 through 2026. And if you look at the red box at the bottom, that is the supposed silver deficit as reported by Metals Focus and the Silver Institute. Now that started in 2019. So I started highlighting that 2019 to 2026. If you add all that up together, that's thousands upon thousands of tons of an implied shortage. This is a survey I have quoted probably 25 or 30 times in my own presentations and writings, and it's certainly one that is circulating around the internet. There are flaws with this study, however, and I want to point them out to be fair. To defend myself, I've talked about some of these flaws. One of the reasons I put this presentation out is to put all of that on paper, visually in a PowerPoint presentation, all in one place, because there are people that have criticized me for even quoting this survey, just assuming that if one number's wrong, maybe they're all wrong, and that's not really a good assumption to make. So I thought, well, let's just do a presentation and go in detail so you guys can know how I feel about it. But then also, I want you to see the numbers so you can figure out how you feel about it. This is educating you on what's going on in the market, especially if you're a silver investor. All right, we're going to march forward. I just wanted to show this chart to show how they're calculating. Let's go real quick over. Supply is mine production, recycling, net hedging supply, and net official sector sales. Don't ask me to explain what those are. The first two are, I think, obvious. The next two require you just go read the report. It's easier than me telling you. Otherwise, this presentation may end up going hours. Demand is industrial. That's, for applications, TVs, military use, all that kind of stuff. Then you have electrical and electronics. Then you have photovoltaics as a part of that. Silver and photography, photovoltaics, whatever you want to call it, is waning. It's still an important part of worldwide silver demand, but digital photography is replacing that. Brazing alloys, which is stuff that, brazing is where you connect things together that are metal with a brazing alloy. It's sort of like what you do to your pipes, although that's a slightly different similar process, different components. Photography, jewelry, silver, and coin and net bar demand. We'll get more into coin and net bar demand as we go further down. That's just a general explanation. If this chart confuses you, just look at the green, the orange, and the red box. Green box is supply. Orange box is demand. Red box is where demand exceeded supply. It's all you really need to know for this presentation. All right, moving on. The Silver Institute Metals Focus, which does this worldwide silver survey, they produce the annual World Silver Survey. And in recent years, they have proposed supply deficits resulting in 43,000 tons. To get to that number, I just added all those red numbers, those boxes encapsulated in a red box at the bottom to come to that 43,513. Just an addition exercise, not hard. That particular point, the shortage, is what often gets debated in precious metals circles. And it's not just the number of the shortage, but how they arrive at the number that is disputed the methodology, how they get there, what assumptions they had to make. When you're doing any sort of study, there may be things that you don't know 100%. They may not be 100% auditable or certifiable. We'll call that auditifiable. I just made a new word. So you're going to have to make assumptions to fill in the gaps. And each study makes some assumptions. And that's really where the key differences are. And I don't think that either study is perfect. I think they have their flaws, but they're interesting views into the silver market. So let's go a little bit further. Recent revisions in previous supply demand numbers have led critics to question the study's overall reliability. In some cases, they moved numbers down that were previously reported. In some cases, they moved them up that were previously reported. And so people are going, wait a minute, is this an accounting trick? You already published these numbers, you changed them. I don't trust your whole study. The changes were based on changes and refinements in their methodology so that they could get more precise. And they explain it on the study. So if you want to know, if you're like a numbers geek like me and you want to know, go look at the study. They'll tell you all about it on their website. Just Google Silver Institute Metals Focus World Silver Study. It'll take you right there. All right. Criticisms of this survey, broad criticisms, that investment demand, meaning the coins and bars and that type of thing, is counted as silver taken out of the system and not added to above ground stocks. So you're saying I'm demanding this for investment, but then the assumption is that that bar can't be resold, at least not in the short term. And this is a key difference between the two studies. The Silver Institute study is basically saying on a year-by-year basis, this is how we look at it. And I don't have a problem with that methodology, but you still have to tell people, wait, even though we're taking it out of the numbers because it's demand, which is true at the point in time, it could be put back on to the market. And it's that stuff that could be put back onto the market, which could affect silver price moving forward in the future. In other words, you can resell silver just like you resell a pair of boots, a car, whatever, a baseball bat, whatever you want, except for the fact that silver actually tends to not deteriorate over time like those other things. It's not as consumable if it's just sitting in a rounder bar. And so that means that silver mined 50, 100 years ago could be brought back on market. Okay. And they don't really account for that specifically and visually in the world silver study. And as I've said many times over the years, when silver price rises, some people will sell these ounces back to the market from storage. I have said that in many videos. People have criticized me in my interpretation of this study from Metals Focus and Silver Institute is that I didn't say this, that Rob, there's still above ground silver stock available. True, although that's not 100% true, but I have said it over the years. And I'm going to get here in a minute to a chart which is going to prove that point. And we'll get there in a minute. All of this discussion on this slide implies that the deficit reported by the Silver Institute is overstated. So maybe it's not 43,513 tons that you see on the chart. Maybe it's some number below that. Let's go explore that a little bit more. I'm just going to stick this in here to make a point. I have made this point on videos all year long. In fact, I started making this point on videos almost a year ago, about this time last year. I saw a spike in silver inventories come onto the COMEX. That doesn't look like a shortage, does it, ladies and gentlemen? Look at 2025. I've got it highlighted in orange. They added 200 million ounces in 2025 to the COMEX. And a lot of that is in dark green registered stocks, which is unencumbered. It means you can trade it. The eligible means it's privately owned at a certain price. As long as it's not pledged to another contract, it could be sold. But it's the dark, look at the increase in the dark green. That is a ton of increase of available silver stocks. And if you look prior to that increase, you had about 300 million ounces. What do you have now? Slightly over 300 million ounces. We actually have more total ounces than we did in 2024 before we had the big runoff to end 25 and go into 26. So we actually have slightly more inventories than we did 2 years ago. So even though in 2020, late 2025 and in 2026, tons of silver move off the COMEX, ostensibly, I think a lot of it overseas to the east, we're still at the same inventory number. So wait a minute, if we had the spike at inventories in silver in 2025 on the industrial side, how does that support Silver Institute's assertion that we have this big shortage over since 2019 that's on their chart, which adds up to 43,513 tons. Now, there are some possible explanations for this. I'm teasing. Stick with me and I'll show you. So I'm not trying to overly criticize this study. I think there's some things in favor of their analysis and some things which maybe we should question. And that's exactly what we're going to get into. Now, CPM criticisms of this study. Well, general criticism. CPM is criticized, but a lot of people have. I don't want to call CPM out specifically. But the CPM group has argued that investment demand adds to above ground stocks while fabrication or manufacturing removes it. Makes sense. You put it in an iPhone, it's really hard to get it back out. That's not easily resellable silver, and a lot of it ends up in landfills. If you put it in a Tomahawk missile and you blow it up, that silver is disintegrated. So there are cases in which silver is destroyed, either permanently at the atom level, or it's just put into a product which is thrown in the trash, which to get it out, you would have to go run a mining operation in your local landfill, and there are thousands upon thousands of those across the U.S. Good luck doing that. Maybe silver gets to a price at the point which somebody's going to do that. They're going to run their dump trucks through there, grab all that crap, maybe burn off the stuff and extract out the silver. But I would think silver dollar prices per ounce would have to probably climb to at least $120, $150 an ounce for that to be profitable.
A primary methodological divide in metals research stems from the classification of secondary scrap recycling and retail bullion. While worldwide primary mine extraction figures remain consistent across analytical groups, secondary recovery estimates diverge significantly. Certain frameworks record minted coins and investment bars as permanent demand that exits the market system, whereas contrasting analyses view private holdings as potential floating inventory that returns during high-price environments. Furthermore, secondary scrap recovery from jewelry, silverware, and industrial components fluctuates in direct response to price movements, mobilizing dormant physical stock into commercial refining channels. Now, let's get back to the interview.
All the refiners are sending reporting to the public. Well, I took in so much scrap, and you can apply it from some accounting reports for the company, but a lot of them are private and they don't have to publicly report. All right, belabored that point. Let's get into scrap. Now I'm going to continue to build an argument which you're going to understand at the end. I'm switching from bullion to scrap. Most bullion doesn't go into scrap, some does. But here's what most of scrap is. In 2024, scrap had reached a 12-year high since 2012, right after the big boom in silver and gold, and it started to come back down. Remember, in 2011, we hit peaks in gold and silver. Silver and gold came down to 2016. Okay, so there was a lot sold in 2024. People were selling as the price is going down to take profit of their physical metals. So in 2024, we reached a 12-year high. Why in 2024? Prices had gone up so much, and we didn't know that silver was going to go to 121. People were selling at 60, 70, 80, maybe 50, 60, 70, 80, because they might have bought silver when it was 20. It was a good trade for them, to the tune of 193.9 million ounces. Now, notice here this next part of the first bullet point. Scrap recycling is assumed by Metals Focus Silver Institute. Well, assumed. I mean, they have calculated using their methodology that only 15 to 20% of supply. That's not what CPM Group says. We'll get to that in a minute. All right, industrial scrap, industrial jewelry and silverware and photographic make up most scrap recycling. There is some consumer bars and stuff like that, but most comes here. Industrial scrap is typically between 50 and 60%. Jewelry scrap, very sensitive to prices. Silverware scrap, very sensitive to prices. Jewelry scrap in 2024 was up 8% as a percentage of the whole, and silverware scrap was up 11% as a percentage of the whole. Photographic scrap is still around, but not as much because of digital photography. If you remember the old days where you'd use a film camera, even fancy ones that would have silver in them and part of the development process of the film, Polaroids use silver and they use a lot of silver in there. That's in decline because of digital photography, which makes sense. It's still significant around the world. It's just not as significant. All right, moving on. What are the similarities between the two studies? Well, they're pretty close in mine production. The USGS World Mine estimates actually agree with Metals Focus Silver Institute more, and CPM Group is usually understated to those two, but it's close enough that you don't just sit there and argue with it and saying, yeah, it's 1 or 2 or 3 or 4 or 5 million ounces. Nah, it's okay. I mean, that's not going to explain above ground inventories as much as the next slide will. So by and large, CPM Group and Metals Focus basically agree on mining. There's a lot of data reports out on that, plus a lot of private relationships on what that is. And so that's how they come to a very similar number. That's not what's in dispute, in other words. What's in dispute, this is the key to the whole thing to determining whether you believe there's a surplus or a shortage. Metals Focus has a much lower number year over year for scrap and recycling. Why does that matter? If you're recycling silver, I've got an old peace dollar right here. You can't even see it because it's so worn down. That used to be money in the US. You may scrap this because it doesn't have resale value. You just take the silver value. It's an old coin. No numismatic value, no collector value. It's beat up and old and the design's worn off. You can just scrap that darn thing, right? But other scrap, silverware, all that kind of stuff that we talked about, industrial scrap, all the stuff, Metals Focus has a lower number. So when you scrap that stuff and put it back in the system, that is supply. In fact, it's just recycled supply. So you're taking previous year's silver and throwing it back in the system to meet demand. So somebody has to sell it and it has to be refined or redone and a person has to buy it. Okay. So the only case in which that's bullish for prices is that because buyers are buying more new silver than sellers are putting into scrap, if that makes sense. Okay. CPM Group estimates are consistently higher, as you can see on this chart. The 2 explicitly reported years and a couple more that get pretty close to explicit reporting that we are able to collect. And so this is the key difference. CPM Group says there's more recycling than Silver Institute reports, which means more above ground stock. Now, it doesn't change the total number of stock. It just changes the amount of stock that has come out of people's coffers to meet existing demand. Okay. So what that means is CPM Group is saying more and more silver is coming into the market on a yearly basis. It's already mined silver, but it's coming out of hidden places where we're sitting there doing nothing, and it's meeting current demand. It does not change the overall amount of silver ever mined. It just changes the amount of silver available on a year-by-year basis, which may explain some of the price dynamics of silver, even though people have been screaming silver shortages for a few years like me. Well, are they really shortages? If you read the CPM Group report, then you may decide, well, maybe the shortages aren't as bad as I thought. So where the divergence occurs, and I'm going to get into criticisms of both studies. This is not me loving one study over another. I know that this is like a football game, and it's the Dallas Cowboys and the New York Giants. And Silver Institute's the Dallas Cowboys, and CPM is New York Giants. And if you like CPM Group, then you're going to scream at me because you think I'm telling you their report's not accurate. If you like Silver Institute and the Dallas Cowboys, you're going to scream at me and say that I don't like that report. I'm going to criticize both because I'm trying to get to the bottom of it by looking at different methodologies. And at the end, what you'll find out is a lot of these numbers are hard to track. All right. CPM's higher estimate of scrap and recycling on a yearly basis has led to their reporting of large above ground stocks when accumulated over 50 years. If you take the difference on this table and you multiply it by 50 years, that's part of why they have 6.5 billion tons of above ground silver. It makes a difference over 50 years, doesn't it? Silver Institute's assumption of lower scrap recycling leads them to the assumption of yearly deficits of silver to the tune of 43.5 thousand tons. Okay. Now, the flaw in that approach, that is mathematically true in the year that it's done. But if lower scrap is true, that means more silver's being held. It still means it could come back on the market, if somebody wants it at the right price. It doesn't destroy overall inventories. Totally. Part of it may be destroyed, in missiles and in iPhones that get thrown into landfills, but that's only a percentage of the whole. So if there is lower scrap, that means some of the existing bullion is still out there. And Silver Institute doesn't really account for that on their bottom line. That is the main criticism of that report. That one difference is the main sticking point between those two reports. Now I'm going to go to CPM Group and I'm going to praise and criticize something on their report, implied unreported stocks. If you remember, let's go back up to the slide before where I said CPM Group estimates 6.5 billion ounces exist in coinage, and implied unreported stocks is the biggest number. There's a video out there where you have a chart of all above ground silver stocks that CPM Group is saying exists. And the biggest, both the one that has changed the most since 2010 in total numbers and grown the fastest is this implied unreported stock. So I thought we got to break this down because this is the key difference between the two reports. So going back to my busy slide here, I'm going to read all of this, so don't worry. Again, this may be a spot because it's busy with a lot of information that you pause or replay this again, totally fine. All right. This number, implied unreported stocks from CPM, does not include government minted coins. So they've separated government minted coins, eagles, maples, all that kind of stuff. So it implies that this number is looking at non-government printed third-party rounds and bars of various sizes, maybe even some 1,000-ounce ones, maybe some 1 ounce, 500, whatever the case may be, kilos. All of those are privately held and cannot be audited. This is key, and that'll be the key to my criticism as a former auditor. You can't really audit that number, and here's why. We'll get their methodology first, and then in purple, I'll get to why you can't audit it. CPM Group allocates the differences in reported stocks versus those that disappear into private coffers since the 1970s. That's why this number is so big and why we're looking at it. Exact ownership of that private silver is not verifiable. Therefore, you cannot audit it in present tense terms. CPM Group alleges there are so many billion ounces above ground, but how do they know if you can't audit the chain of custody? How do they know if you can't audit all of the private holdings, what that number really is? It's in pot, you can't. So is that number correct? The chances are high that it's not correct. Is it overstated, understated? That's really where it gets interesting.
Calculating total global physical reserves presents fundamental auditing challenges due to the decentralized nature of privately held bullion. Long-term accumulation models asserting that over 6.5 billion ounces exist in unreported private stockpiles rely on multi-decade statistical assumptions dating back to the 1970s rather than verified physical vault audits. Because third-party rounds, commercial bars, and non-government mintages lack a centralized chain of custody. Exact ownership and liquidity cannot be authenticated in real time. As high-tech manufacturing, aerospace, and defense applications permanently consume physical metal, unverified private hoard assumptions risk understating the true extent of exchange inventory depletion. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.